Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Analog Devices, Inc. quarterly report. Analog Devices, Inc. offers a diverse range of products and services to various industries. At the core of its offerings are data converter products that translate analog signals into digital data and vice versa. These products cater to multiple markets, including automotive, communications, industrial, and consumer sectors. The company's product portfolio also includes power management and reference products for applications such as power conversion, driver monitoring, sequencing, and energy management. Additionally, Analog Devices provides amplifiers to condition analog signals and radio frequency and microwave ICs that support cellular infrastructure. Furthermore, the company offers microelectromechanical systems technology solutions, including accelerometers, gyroscopes, inertial measurement units, and broadband switches for various applications. Its digital signal processing and system products are designed for numeric calculations. Analog Devices serves clients across multiple industries through a direct sales force, third-party distributors, independent sales representatives, and online channels. The company's extensive product range and global reach make it a significant player in the market. The stock price of Analog Devices, Inc. (ADI) has experienced a significant increase of over 43.96% in the past year, driven by several positive news events. The company's strong financial performance and optimistic outlook have been major contributors to this rise. One key factor was the exceptional fiscal first quarter 2026 earnings, where ADI reported robust results that exceeded analyst expectations. The non-GAAP earnings per share reached $2.46, surpassing the Zacks consensus estimate by 6.5%, while revenues hit $3.16 billion, a substantial 30% year-over-year increase. The company's strong fiscal second quarter 2026 guidance also fueled investor optimism, projecting revenues of approximately $3.5 billion and adjusted earnings per share of around $2.88. This exceeded consensus estimates, signaling continued growth momentum. In addition to these financial results, ADI's management highlighted sustained bookings growth, particularly in the industrial segment, and record-breaking orders within the data center segment. The surge in data center demand is largely attributed to investments in AI infrastructure, with the data center segment's revenue run rate reaching $1 billion, experiencing a 50% year-over-year growth. The company's confidence in its sustainable earnings trajectory was further demonstrated by an increased quarterly dividend of 11%, marking the 22nd consecutive year of dividend increases. Analysts also upgraded their ratings on ADI stock or significantly increased their price targets, reflecting growing investor confidence. Overall, the combination of strong financial performance, optimistic outlook, and positive analyst upgrades has contributed to the substantial appreciation of Analog Devices, Inc. Stock in the past year. Analog Devices, Inc. maintains a market capitalization of $169 billion, broadly in line with the industry peer group. Analog Devices, Inc. trades at a higher price-to-earnings ratio of 76 times and a lower price-to-book ratio of 4.99 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 30% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth can be identified in two key areas: segments and end markets. Within the company segments, the industrial segment saw a significant increase of 38%, followed closely by the communications segment with a remarkable 63% rise. The consumer segment also experienced growth, albeit at a slower pace of 27%. Additionally, distributors played a crucial role, contributing $366,830 to revenue growth, representing a 26% increase. Furthermore, examining the end markets reveals similar trends. The industrial end market grew by 38%, while the communications end market surged by an impressive 63%. The consumer end market also saw growth, albeit at a lower rate of 27%. These figures suggest that both internal segment performance and external market conditions have contributed to revenue growth. Net income experienced a significant increase, rising from $391,316,000 to $830,826,000. This represents a substantial growth of 112%, or an increase of $439,510,000. Comprehensive income also saw a notable rise, increasing from $391,603,000 to $836,967,000. The profit margins underwent considerable changes as well. Gross margin increased significantly, rising from 59% to 64.7%. This represents a substantial improvement of 570 basis points. Net income as a percentage of revenue also saw an increase, rising from 16.1% to 26.3%. The primary reason for these changes can be attributed to the significant increase in revenue, which rose by 30%. However, special charges and impairment charges had a negative impact on profit margins. Despite this, the company's net income and profit margins were able to recover and show substantial growth. The company's financial performance indicates a positive trend in its ability to generate operating cash flow. The data shows that the net cash provided by operating activities has increased over time. In January 2026, the company reported $1,368,515 in net cash from operating activities, which is higher than the $1,126,809 recorded on February 1, 2025. This increase suggests that the company's operations are generating sufficient cash to meet its financial obligations and invest in growth initiatives. The company's debt level and interest expenses have undergone significant changes. Firstly, the total debt has increased by a substantial amount of $1.7 billion, rising from $7.09 billion to $8.76 billion. This increase in debt is evident across various time periods, with current debt standing at $898,900, previously $0, and long-term debt decreasing from $8.15 billion to $7.24 billion. However, despite the fluctuations in debt levels, interest expenses have seen a notable rise. The company's interest expense has increased by $11.08 million, jumping from $75.26 million to $86.35 million. This increase in interest expenses is likely due to the higher debt levels and potentially rising interest rates. Overall, these changes suggest that the company's financial situation is becoming more complex, with increasing debt and corresponding interest expenses. Management is projecting continued revenue growth as a key component of the company's strategy. To achieve this goal, they will focus on driving growth through various initiatives. Despite their optimism about the company's future prospects, management acknowledges that actual results may differ from forward-looking statements due to external factors. The company views research and development, R&D, as crucial for its long-term success, with a continued emphasis on developing innovative technologies and processes for new products. This investment in R&D is expected to drive growth and stay competitive in the market. In terms of financial management, the company will prioritize future repurchases of common stock, capital expenditures, and quarterly dividends based on its financial position, results of operations, outlook, liquidity, and other factors. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends to its investors. As per the records, the company has indeed paid dividends in the past 2 years, with amounts totaling $484,260 in January 2026 and $456,338 in February 2025. In addition to paying dividends, the company has also been actively involved in share buybacks. With an authorized amount of $26.7 billion and a remaining balance of $9.1 billion available for repurchases, it is clear that the company has made significant investments in buying back its own shares. This move not only benefits existing shareholders, but also helps to boost the company's stock price by reducing the number of outstanding shares. Concerns about inventory buildup and supply chain disruption are emerging due to a significant increase in raw materials, work in process, and finished goods inventories. According to recent data, these inventory levels have risen by $110,781, representing a 7% change from November to January. This surge is attributed to companies building up their stockpiles to meet anticipated increased demand. That concludes the financial summary for Analog Devices, Inc. Feel free to comment below, and I will be happy to answer them when possible.